What's up, everybody? It's Monday, September 8th. Did you ever sleep wrong and wake up with like a pain in your back? That's what I have, man. So it's restricting my movement a little bit. Oh, wow. I hope you had a nice weekend. So, market was up today. All three averages were up. Fiscal flows looking good. Leading flows still going straight up. A little bit concerned about net transfers because they look like they kind of stalled out when I look at it on a year-over-year basis. And I'm not saying that's bad, but I would like to see that continue to move higher. We've basically been stuck at a level since May 1st. When you look, again, that's on a year-over-year basis, net government transfers. What I am looking at now, or let's say giving more attention to, because I look at it all the time, is bank credit, particularly loans and leases, and that's rising at the fastest rate in 2 years. So that wouldn't suggest to me anyway that there is a problem in the economy. If credit demand is strong, that's usually an indication that people or businesses see opportunity, so they're accessing credit. So I'm taking that as a positive. And one of the big drivers of loans has been commercial and industrial loans. And that is at the highest level in 63 months, over 5 years. And that kind of ties in, I think that ties in with the Trump policy of trying to get more domestic private investment. So I'm using that as a barometer, and right now, to me, that's suggesting that that's good. I mean, that trend that we're seeing, highest level in 63 months, the growth rate of commercial and industrial loans picking up, that looks good to me. So I guess I'm paying a little bit more attention now to credit trends. Of course, fiscal flows are still the core of my analysis. And until I see a definitive drop in those net government transfers, like if that develops into a trend, if that year over year starts to trend down, that would worry me, and that would suggest to me anyway that we're going to see a slowdown and possibly even a contraction in the economy. Right now, I'm not calling for that because even though it's flat, it's stable, and it's not advancing, it's not accelerating, but it's still up like 266, 270 billion over last year, which that's still a significant amount. I just don't want to see that start to trend down. And so until that happens, I think the picture remains positive. If you include sentiment now, and I spoke about this last week, the AAII weekly sentiment survey, individual investors have a very low level of bullish sentiment and a very high level of bearish sentiment, and that survey, the way you look at that is on a contrarian basis. In other words, low bullishness, high bearishness. You would equate that to the likelihood of the market going higher. That's what I think. We got Fed rate cuts coming up. This week we're going to have the CPI and the PPI. Again, I don't really pay much attention to that. The irony is that, we've seen what happened over the last 3 years with the rate hikes, where everybody said that the rate hikes were going to end up causing a recession and a market crash and the worst market environment since the GFC back in 2008, 2009. I was the only one who said that was not going to happen. because rate hikes, I told you guys, that's a fiscal operation, and it is going to end up increasing interest income transfers by a very large amount, and that's exactly what happened. So you had the government basically adding income to the economy. You're not going to get a crash in that situation. The funny thing is, I'm reading a lot about how hedge funds are loading up on gold right now. They're like, yeah, now's the time to buy gold, right? Now we got to buy gold. Because they're looking at what's likely to be a resumption in the Fed rate cuts. But they don't understand monetary policy. They don't understand the impact of rate adjustments. I explain it on this channel many, many times. And I'll say it again, that when the Fed starts cutting rates again, first of all, we've seen what the initial round of rate cuts have done. They started them last year. The initial round of rate cuts, right? They brought the Fed funds rate down from 5.5% to 4.5%. That has resulted in a 41 billion drop in T-bill interest transfers. Overall interest income transfers are up, but that's because when you add interest on Treasury securities, it's adding more than what has been subtracted from T-bill interest. But now that the Fed is going to resume rate cuts, it's just going to accelerate the drop in T-bill interest to the point where maybe that drop might wipe out interest income that's being transferred as a result of Treasury securities. And don't forget, and I said this in previous videos, that Treasury under Secretary Bessent is relying more heavily on short-term securities like T-bills. So that reduction is going to become evident very quickly. I mean, we'll see it early in 2026, maybe even before. So be prepared. So the reason I'm saying this is because all these hedge funds saying, now we got to get in gold. They don't understand, like in 2022, if you guys were following me back then, or if you were a subscriber to my report, gold was at 1,600 and I was pounding the table on gold. I said, this is the smallest short position, I think, ever that gold producers had in the futures markets. I kept saying, gold producers are holding the smallest net short. Now, they're always net short because they own the physical gold. So they sell to lock in their profits. But their net short position back in 2022, I think it was around March or April 2022, was the smallest net short position that I have ever seen. And I think I went back like 20 years or something like that. And I was saying, you got to buy gold, you got to buy gold, you got to buy gold. All right? And the gold rally, and here we are, we more than doubled because we're at 3,600 and gold was at 1,600. So we more than doubled in that period. And that happened while the Fed was raising interest rates. What did it raise interest rates like 8, 9, 10, 11 times, something like that? That rally, so like the understanding of monetarists and these gold people, and I remember leading up to that whole beginning of the rate hikes, when all these gold people were saying this is going to be really bearish for gold, you got to sell gold. I was the guy saying, no, you got to buy gold because number one, rate hikes are, number one, I was talking about the very, very, very small net short position of the producers. The producers saw something at that time, number one. Number two, I said rate hikes are going to be inflationary because that sets the general price level higher. Not that gold is necessarily a good inflation hedge. I don't think it is. But, if you're looking at prices, when you set the rate higher and higher, that just raises the general price level. And number three, maybe most important, was that the rate hikes were going to significantly increase interest income transfers, national income, all else equal. You're just pumping income into the economy. That's going to flow into risk assets. It flowed into stocks where everybody said there was going to be a crash. Not me. I said it was going to go up. Everyone said there was going to be a recession. It was universal. Not me. I said it was the economy was going to be fine. Now, when they're looking at rate cuts and they're saying they got to buy gold now, it's not going to work out. It's going to go the other way. And the irony is that the rate cut that's coming up, and I right now the market's pricing in 3 for this year, 1 in September, I think 1 in October, and 1 in December. I'm saying right now, that's going to mark a significant, important top in gold. I don't think it's going to be like the forever top. Nominal prices always rise over time. But I'm saying it's going to be where this thing, we could have like several years after the price comes down of gold, like kind of doing nothing, languishing for a while. I looked up the other day, what is the average cost of production, like mining cost for gold? And it runs anywhere from $800 an ounce to $1,600 an ounce. So pick a number within that range, because I remember the 1990s, after the big run-up in gold in the 1980s, and then you had a long period, a very long period after that peak, when gold peaked at 850 and then it came down. It was like more than a 10-year period where gold just kind of sat around doing nothing at $250 an ounce. And it sat there. That was a price below the cost of production. For years, it just kind of languished below the cost of production to the point where a lot of investment was taken out. There was a big decline in investment in gold production. Mines were shut down, that sort of thing. I mean, I could definitely see that happening again. I don't know what price level, but like I said, from 800 to 1600 is what when I did my research on what is the cost of production, the average cost of production for gold, to mine it, to pull it out of the ground from 800 to 1600. I mean, pick a number in there. I mean, we will definitely see somewhere in there at some point in time, because that's just the way it is. You pump out a lot of gold. Every ounce of gold that has ever been mined or taken out of the earth is still around. It's not like oil where you burn it and it's gone. I mean, so people have gold, they could sell gold. All the supply is still here. So, but I'm just talking about from an understanding of monetary policy and the impact of rate adjustments. And remember, what I always tell you guys, we're going to come back and revisit this. What I said, what Mike Norman said. We're going to come back and revisit this, because nobody, I guarantee you that nobody else is telling you this, because they don't understand. They do not understand. Anyway, that's it for today, folks. Thank you for watching. Please like and subscribe. I'm going for 20,000 now. I just got to 10,000. It took me, I don't know how many years. It took me 16 years to get there. All right, let's go 20,000. Yeah. All right, please like and subscribe. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Bye.